technical trading, technical indicators, NVIDIA, as well as consumer confidence. Gary, I'll let us get into what I think is the most exciting part of the show and introducing our guest.
Here we go. So excited to be talking today with somebody who contributed one of our 5 things this week, Enrique Abeyta from HX Research. Enrique, how are you today?
I'm good. I'm good. You know, grinding away here on a Sunday.
Good. Well, thanks for joining us. One of the reasons I'm excited to be talking to you is DKI exclusively focuses on fundamental research and macro. You have made a lot of money based on technicals. And so I think for you, it's been predictive. Let's talk about what you have on your mind right now.
Yeah. Well, look, I think I employ what Steve Cohen called a mosaic approach, right? Which is we spend the majority of our time also in fundamentals, whether that be company fundamentals or macro fundamentals, but we utilize technicals to optimize our investment strategies, whether those are trading or investing strategies. So what I was excited to talk to you about this week is, there's a very, very rare technical signal that's just came up, and it's very, very powerful. Now, let me be clear. What do I mean when I say technicals? Technicals basically means the analysis of past price and other data, generally volume would be the other piece in there, and other derivations of price, including volatility, things you can calculate like RSI, et cetera. And the idea is that we can never know the balance of buyers and sellers and what everyone thinks and what their emotions are, this incredibly complex organism that is the stock market. But price is truth. Price tells us where the market is. And so what happens is sometimes in the market, we see trends that can tell us what is going to happen next. And the way I explain this is, I love talking about blackjack. I write a lot about that. I grew up in Arizona. My parents met in Reno. My mom was a cigarette girl. My dad, his last 20 years, was a professional gambler. And, the thing about blackjack, if you've read, and there's a couple blackjack books on my bookshelf back here, if you've ever read about how to play good blackjack, and I'm not even talking about counting cards, but let's go to counting cards, is you never know that you're going to win any hand no matter what you see with the cards, but the probability increases, okay? So what we like to do in our trading strategies and with a lot of our strategies is you could have the best thesis in the world, the best idea, et cetera, and you're still going to lose. Something's going to happen. That's the nature of reality. That's the nature of the stock market. But you can bend probabilities, or you can identify situations where probabilities are in your favor. And so what's happening right now is we just completed the month of March. March was up. I'm going to pull it up here in my Bloomberg. Give me 1 second. Let me get the final number. But March was the 5th month in a row where the stock market was up. The S&P 500 was up more than 1%. Okay, so 5 months in a row of 1% or greater performance. So by the way, the S&P for the month was up 3.10. So it did a hell of a lot better than up 1. Now, that occurrence, 5 months in a row of plus 1% or more in the S&P 500, has only happened 12 times in the last 75 years, okay? Now, what I'm interested in, the reason that this is predictive of potential probabilities is that when you have something happen only 12 times in 75 years, that means that there's a unique set of circumstances and they probably share a lot of commonality. So what's interesting to look at is what happened next, okay? In the following month after those 12 previous times, what happened was the stock market was up only about 60% of the time. Now, I'm going to tell you that's actually greater than any random month. The stock market's up 54% of the time normally. But when you go out 6 and 12 months, 11 out of 12, the stock market was higher 6 months later. 12 out of 12, it was higher. 12 out of 12, it was higher 12 months later. That was a lot of 12s. And the performance of the market in the 6 months was 35% greater than a normal 6-month forward performance and 50% greater in a normal 12-month performance. So this is the blackjack. And again, I apologize if some people don't follow blackjack, but this is the equivalent in counting cards of the dealer having, dealt out all the small cards and you're sitting with a bunch of face cards. And so, look, This doesn't mean the S&P 500 will be higher 6 and 12 months later. It's not a guarantee. There's no guarantee that it'll also be higher on average more than what it normally does. But I got to tell you, your odds are pretty good. So what we do, and I'll kind of finish with this, this is part of our mosaic. It doesn't mean we go from being bearish to being bullish, or we're going to make some big bets on this. But when we're putting our mosaic to understand both our trading and investing strategies, because we have both, this is another piece that goes in the mosaic. And this is a unique, like I said, this has happened 12 times in my 30-year career. I think it's happened 6. And this might only be the 3rd time I've actually been paying attention to it. So it's a pretty rare occurrence and worth highlighting.
That's a great explanation. For some of the people who aren't constantly working in finance, let's unravel a couple of the terms Enrique brought up. He talked about probability analysis, and that's a key part of not only how gamblers approach managing their cash flow, their money, but also how investors think about things. So let's just take 2 examples, right? Let's imagine a scenario where you have a stock where you think there's a 50% probability that you lose all your money and a 50% probability that you make 10 times your money. You would put that on. You would put that trade on. You'd make that bet. Let's give another example. Let's say there's another stock where you think there's a 90% probability that you make 20% and a 10% probability that you lose 20%, right? So your upside and downside are the same, but the probability of making money is higher. You would do that, right? So that's what he's talking about. Where are the situations where you want to have more money invested, and the situations where maybe you'd either invest less or stay away from it. So Enrique, based on the strength of this particular indicator, which, as you pointed out, comes up once or twice a decade and has been predictive 100% of the time, how does that affect how you're changing or setting up your market exposure right now?
Well, you know, our products are very disciplined. Again, we have trading and investing products. Both styles are made to make money in any market. You know, our trading strategy, HX Trader, in 2022 had 74 recommendations. They were all long, so we didn't do a single non-long, didn't do any short ETFs, and we were up 9% on an absolute basis. So I build my portfolios to perform in all markets. I will say this, we were already constructive, but, you know, I don't know, maybe I'll be a little bit more aggressive in buying the dip, you know, when the inevitable dips come, because we do think, you know, some corrections make sense at some point. But again, it's just one of the pieces of the mosaic. So I don't know, how would I say this? I'm still sailing the ship the same direction and in the same way, but maybe at moments in time, as the winds and waves hit that boat, I may react slightly different than I would normally. So it's a small piece of the mosaic, but it may present some real great money-making opportunities.
You know, one thing we've talked about a lot on this program that I think is a tailwind for you is just massive amounts of governmental overspending. One, that's trillions of dollars of additional stimulus hitting the economy, which will be positive for the stock market, right? That they blow up asset bubbles. And then the second thing that I would add to that is all of that spending creates more inflation. And, you know, high inflation can also potentially lead to higher stock prices, depending on the timing of what the Federal Reserve does. Any thoughts on that?
Yeah, look, I think the macro backdrop is fundamentally constructive. I mean, you know, rates are higher, but they're not actually high. Inflation is higher, but a lot lower than it was and not actually high. And one other piece of data that I saw recently, I think this was from Bespoke Investment Group, was that it is statistically significant that the Federal Reserve is less active during presidential election years. Like, it stands out. It's materially, you know, when you look at the data. And so I kind of think we're in a market where the Fed's just not going to do very much because they don't want to be viewed as being political. Although I do think they have political tinges to it. So look, we of course we could have a war. We could have a COVID, you know, we could have kind of anomalous exogenous factors that we can't predict. But I'll tell you, we just had a whole bunch of those and we've kind of been shaking them off. So, you know, look, most of the time the market goes up. Bull trends persist for, you know, 30, 40, 50 months. I'm not telling people to go out and lever up into this, but the trend is your friend during certain periods. And, you know, I think you should constructively and tactically take advantage of it.
Makes sense. All right. Thanks so much, Enrique. For people who are interested in what you're doing and see the value of the great research and money-making stock picking you're doing, how can they find you?
Well, we have a free daily email, which is the HX Daily. That's at daily.hxresearch. H is in Henry, X is in X-ray. Daily.hxresearch.net. And you can follow me at Enrique Abeyta, one word, on X Twitter.
Sounds good. We'll put the link in the description so it's easy for people. Thanks so much for joining us today. We really appreciate it.
Appreciate it.
Thanks so
All
much.
right.